Okay, so we have gone through some of the key considerations when investing in SPACs. If it is something that you are potentially interested in investing in, we will then go through the different investment strategies for SPACs. So here what I've showed would be the performance of US listed SPACs since April 2020. What we see is that they have been very volatile. If we index it to April 2020, they did very well through most of 2020 and peaking at the early part of last year. Thereafter, we have seen a decline in the share price. And what this means is that if you have just been holding on to a basket of SPACs, like through this ETF, and holding it over time, then your returns will probably not be too spectacular. In fact, you have seen very volatile share price movements along the way. So what we want to do instead is to think about whether we can find an investment style or strategy that is more suited for our individual preferences. Okay, to be able to do that, what we want to go through first is the SPAC life cycle. So we mentioned earlier that what happens at the start would be the sponsors listing the SPAC units through an IPO. Thereafter, the SPAC units will be detached into two different parts, the SPAC shares and the SPAC warrants. This typically takes place 45 days after the IPO, but it can differ from SPAC to SPAC. Whether it's an automatic detachment or it is not automatic detachment can also differ from SPAC to SPAC. So we need to be checking the prospectus very carefully to make sure that we are aware of all of the terms. Thereafter, the SPAC sponsors will go about looking for a target to acquire. Once a target is identified, what the SPAC sponsors would do would be to hold an extraordinary general meeting for investors to vote on the business combination. If the investors vote in favor, then the business combination is completed and the new entity starts trading. If the shareholders vote not in favor, then we go back to the initial process where the SPAC sponsors have to find other targets and allowing the investors to vote as to whether they like this new target or not. Through this whole process, as part of the regulatory requirements, the SPAC sponsors have up to a 36-month time frame. So that is something to constantly bear in mind. Okay, so we can look at a practical example. And in this case, I'll use Grab since it is a name that a lot of investors will probably be familiar with. So if you were to look at what happened before the business combination took place, we saw the SPAC, which is Altimeter Growth Corp, being listed in the US in November 2020. In US, the SPAC listing price is typically at $10 US. Thereafter, we saw volatility in the price of the SPAC, going up to as high as above $16 due to different speculation that may occur along the way. It was announced in April 2021 that EGC is going to look at Grab as a potential business combination target, and we saw the share price bouncing to about $15 per share back then. Thereafter, the SPAC sponsors took time to do their due diligence. The completion of the negotiations were completed in November 2021, at which point in time, the SPAC was trading at $14 per share. The shareholders went to a vote in late November. The vote went through, and the SPAC happened on 1st December, at which time the SPAC was still trading at $11 per share. If we were to look at what has happened this year, we have seen a sharp fall in the share price of Grab. At the early part of this year, it was below the price where the SPAC was listed, trading at about $6. But if we were to look at it yesterday, then it'd be closer to about $3 per share. Okay, so that is the process around a SPAC life cycle. You have probably come across this SPAC warrant, which I mentioned earlier, and I want to go into this concept of a SPAC warrant in a bit more detail. So what is a SPAC warrant? It is effectively intended to enhance the potential return to investors for having their capital being held in the escrow account until the SPAC completes the business combination. What this does is that it entitles the holder of the SPAC warrant the ability to buy into the SPAC shares at a certain fixed price. So one thing to take note of is that when we go through the detachment process, the SPAC unit would break up into the SPAC share and the fractional warrants, and the ratio of the fractional warrants will vary across different SPACs. The point to take note of here is that we want to make sure that we are getting whole numbers of the warrants, because fractional entitlement to warrants will be disregarded on detachment. It is important to take note of this because for different SPACs, there's a different ratio to how many warrants you are entitled to for every SPAC unit that you hold. So it is important to check whether you are going to be entitled to fractional warrants, which is not what we want because they are going to be disregarded, and really what we want would be the whole warrants. The other thing to take note of is that SPAC units may have automatic or non-automatic detachment features. So once again, do check the IPO prospectus to understand the characteristics of individual listings. Okay, so having gone through a bit of what warrants are, we are going to compare how they might differ from the common shares. Okay, so we mentioned the protection mechanism around the common shares earlier. So remember, we have the redemption feature where you can redeem the shares for cash prior to the completion of the business combination. You also get voting rights as a SPAC shareholder on whether you want the business combination to go through or not. But if you're holding on to the warrants, then there is no redemption feature. And unless you were to exercise your warrants and be holding on to the shares, then you would not be having any voting rights as a holder of the SPAC warrants. The other important factor to consider is the dilution risk we talked about earlier. So as a holder of the SPAC shares, again, be reminded that you might be diluted through shares issued as part of the sponsors promote, the PIPE investors, or the exercising of the warrants. The other more general differences between the SPAC shares and the SPAC warrants would be that the shares are generally less leveraged compared to the warrants. And if liquidity is important to you, then the shares are typically more liquid compared to the warrants. Okay, so we'll go through a few different ways that we can think about the different combinations that we can hold either the units, the shares, or the warrants. So we start with this example where an investor buys a SPAC unit for $5 at the time of the IPO. So he will have paid out $5 and gotten one unit of the SPAC unit, which consists of both the shares and the warrants. Upon the splitting up of the SPAC units, this investor actually decides to sell the shares for $5. If it is potentially trading at above $5, then effectively what this means is that he or she would have gotten back his initial investment that he paid up from buying the SPAC unit at the start. But he would continue to hold on to the warrant. And what this means is that he would have paid $0 or might even have earned some money if he continues to hold on to these warrants, because he would have already recovered the capital from buying up the SPAC unit from selling the SPAC shares at above or at $5. This is of course dependent on the various fees incurred, and some of this would include things like your exchange and broker fees, your redemption fees, and other fees. Okay, we next look at another example that we can actually think about. In this case, the investor likewise buys a SPAC unit for $5 at the IPO. Once again, the SPAC unit splits up into a share and warrant. But in this case, rather than selling the SPAC share, the investor decides to sell his warrant. It can be for 50 cents, it can be $1, but then he continues to hold on to the SPAC share. We mentioned the redemption feature earlier. So in this case, maybe the investor decides to redeem the share for $5 per share, or he might decide to sell it in the market for $5 or more if such an opportunity arises. So in this case, what the investor would have done is that by selling the warrants and continuing to hold on to the SPAC shares, where because of the redemption feature, there's a certain flaw in the share price, he or she would have made a certain profit on this investment. Okay, the other way to think about investing in SPAC would be, how is the potential return if I were to buy into the SPAC at below its NAV or redemption price? So remember, because of the redemption feature, investors can be getting back the net asset value or NAV of the SPAC back anytime before the completion of the business combination. So in this case, if the investor had bought the SPAC shares at $4.90 per share, if somehow the SPAC trades up to $5.15 because the acquisition is completed, he has held the shares for 1 year, the return that is being generated here would be at 5.0%. In the other instance where the business combination is not completed, the SPAC is actually liquidated and the investor gets back just his NAV. Even from holding the SPAC for this 1 year period, he would have made a 2% yield by buying the SPAC below the NAV at $4.90 and selling it at NAV of $5 per share. Okay, so we have gone through quite a number of different strategies. Here is a quick recap. There are different risk levels that come through with different strategies. On one end, we have buying the warrants, which is seen to be the highest risk due to the fact that it encompasses the most leverage. And also the protection mechanisms that we spoke about would not be applicable to these warrants. On the other hand, if we were to buy the SPAC at below the NAV, then our risk would be relatively lower because of the various protection mechanisms that are in place, and more importantly, the redemption feature that allows us to take back our capital before the completion of the business combination. The other way that we can think about the different strategies would be in terms of the timeline. So we can think about how and at what stage we want to be involved in SPAC investing. Here, the demarcation really comes through before and after the completion of the business combination, because do remember that before the completion of the business combination, you have the various protection mechanisms in place, including the redemption feature. But once the new entity starts trading, you are effectively holding on to what is no different from shares, and that they are actually subject to market fluctuations, depending on the fundamentals of the company, the industry, and the performance of the earnings of the company. So having gone through the different trading strategies, here's one more short quiz. Which of the following instruments typically has the highest risk? A, SPAC units, B, common shares prior to business combination, and C, SPAC warrants. Okay, so the answer is SPAC warrants because of the lack of protection mechanisms and because they are generally more leveraged compared to the SPAC shares.